Hello and welcome to On the Mark Financial Literacy with Mark Zinman. We have Alicia with Pudgy with us today, as well as Mark. Hello, Mark.
Hello, Monica. Hey, Lisa. Hey, look, Pudge. What's up, dude? You gonna come into the picture today?
And Mark, you have a important birthday going on right now. You were mentioning earlier.
Oh, my granddaughter?
Your granddaughter.
Yeah, my granddaughter turned 4. Yes. And of course, being the smart person I am, I said, right at her birthday, as soon as we bought the camp, I said, how are we going to be next year? So she could say 5. No, she's 4. She's 4. Well, she was a 3-teen, now she's a 14.
So today we're talking about tax planning tips for W-2 employees versus independent contractors, including those who may be working in the gig economy. And I think it would make sense to first start by defining those two different categories. So W-2 employees, right, their taxes are largely handled by their employer. They will complete a W-4 and there will be automatic withholdings. Do you want to talk about that a little?
Correct. So if you're an employee, all the statutory taxes will be withheld, which includes Social Security, Medicare, federal tax, state tax if applicable, local taxes if applicable. Some states also have unemployment taxes that are paid partially by the employee. All that will be taken out and handled. The W-4 informs the employer how you file. I'm married, I'm single, I'm head of household, married, filing jointly. And that is the way most Americans who are not, anybody who's not a gig worker or independent contractor, and you don't know who you are, would have their taxes handled by their employer.
Right, so through those automatic payroll deductions, and as an employee, a portion of your Social Security and Medicare is paid by the employer. Right,
correct. So Social Security and Medicare is a combination of 15.3%. And so 7.65 is paid by the employer, 7.65 is paid by the employee.
Now, independent contractors, so they're considered self-employed individuals. So they have a greater tax responsibility, right? And by that, I mean the administrative burden to manage that is more on them. So let's talk about the self-employment tax. You already mentioned 15.3%. Let's talk about there not being any withholdings.
So you know, if you have a job where you take home $1,000 a week, you may go home with $750 if you're an employee. You're going to go home with $1,000 if you're an independent contractor getting the same amount of money. And yes, you'll be responsible for all your taxes, Social Security and Medicare.
At 100%.
And well, yes and no.
Yes and no.
Okay, so you will be responsible. So in order to make it equatable, you are allowed to deduct 1/2 of Social Security and Medicare that the employer's portion when you're an employee on your tax return. But yes, you would have to send the whole 15.3% in, and your state taxes. There's usually not any unemployment tax, but there could be local tax. There could also be mercantile taxes because you're a business now as opposed to being an employee. So there are different tax situations.
And there are different options, right? And we'll go over a variety of different options throughout this episode today. But one option is what I hear you talking at the accounting firm a lot about, quarterly estimated tax payments. So why don't you talk about that a little bit now?
If you're an employee, you're going to have your taxes paid in through withholdings. If you're not an independent contractor, you're going to have to pay your own taxes in, and the IRS has rules about when that is. There are 4 quarterly estimates. It's April 15th, June 15th, September 15th, and January 15th of the next year. So in this case, January 15th, 2026.
So the 15th of the month following the close of the
right, and the next thing to note is when you owe money, and this is for everyone, self-employed and W-2 employees, if you owe money on April 15th, there's a penalty. The penalty is eliminated by meeting one of 2 safe harbors. The first safe harbor is that you paid in either 100 or 110% of your liability from the prior year. So we're talking about 2025 now. So if your taxes were $10,000 in 2024, you either have to pay $10,000 or $11,000. And it depends what the difference is. If your income's high enough, you go to the 110. If you don't meet that threshold, the second one is that did you pay 90% of this year's tax in? Meaning, did you pay in 90% of 2025's taxes by that last estimate? And we, most tax professionals use the 110%. It's based on the fact that most Americans historically get a raise every year, so you're more likely, if you have the same job or a similar job in the same field, that you'll be making the same, if not more, this year than last year, and therefore you'll have more withheld.
So when we talk about having options and we talk about what is required to avoid IRS or state penalties, talk about, are these quarterly estimated tax payments required if you earn over a certain amount, and what is that dollar amount, or are they optional?
They are not, they're only optional if your tax isn't being paid by through withholdings. Otherwise, they're mandatory. Right? Remember we talked about a penalty. Well, what's a penalty? A penalty is, it's an interest calculation. So I'm going to go back to the $10,000. So the IRS is looking for you to pay in $2,500 a quarter to get to that $10,000. And that $2,500 minus whatever's withheld. So if you have a split family where one spouse is a W-2 employee, the other one is an independent contractor, then basically they're going to have a certain amount withheld, and the rest has to be an estimated payment. And the estimated payment penalty is based on how much you missed the amount by and for how long. So, good example, you pay 0 April 15th, and you pay the other 3 quarters, and now you come to April 15th of this year and you owe just the $2,500. What's the penalty? Well, you didn't pay the $2,500 in for 365 days. You should have paid it in on April 15th, 2025. You're paying it April 15th, 2026. It takes the $2,500, it uses an interest rate, which I think currently is 9%, and it measures how many days you're late by how much. You missed June, it's 270. You missed September, it's 180. So one of the things that we do talk about, because a lot of people don't know, especially gig workers or independent, am I going to have as good a year this year as I did last year? Am I have a better year? And they might not know for a while. So we always encourage our clients to make the first 2 estimates and then look to maybe see whether or not you can cut on the 3rd or 4th estimate. So I'm already getting phone calls, because say September 15th is right around the corner. I'm already getting phone calls about whether or not they need to change or make their quarterly estimate for same independent kind of people we're talking about.
And we'll talk about Form 1099 next, so I'm not referencing the $600 threshold there, but just to come full circle here, if you have a small amount of income, let's say it's less than $1,000, are you still required to file the estimated quarterly taxes, or is there a threshold under which you are not required to do so?
I think there's a very de minimis amount for the return, but you didn't qualify whether the $1,000 is in addition to something else. So if you only made the $1,000, I think if your tax liability is less than $1,000, you don't have to pay the estimates. Or if your tax liability last year was 0, you were a student, didn't have any income, that'd be 100% of last year. So there are some rare cases where you don't have to. But you should, and we're going to talk about in a couple minutes how you start putting this money away. You don't want to be surprised. You know, the whole idea is that even people who don't have financial or accounting backgrounds can, be the manager of their own domain by just following some simple rules that we'll talk about, and to be prepared for taxes and not be surprised.
And you raised such an excellent point, because we do want to draw the distinction of being an employee only, being an independent contractor only, or being both, and we'll talk about that during today's episode.
And I want to point out one other thing here. Regardless of whether you get a 1099 form, the requirement is if you receive money, you have to report it. If you pay out money and you hit a certain threshold, they have to give you a tax form. But those timed to tax forms are changing. So historically, it was always you got a 1099 from your employer, but now you could get what's called a 1099K from Venmo, or you could get it from a merchant services company, or you can get it from Zelle. They all have thresholds, and they're different. But you could end up, having a job where you're a handyman, and you have one steady client and a bunch of other people you do, and the steady client pays you on a 1099, and the other people pay you on through Venmo or whatever.
Mark, do you want to talk a little bit about who will get a Form 1099? Yes,
you'll get a Form 1099 if you. Well, first of all, we talked about what form an employee fills out, which is called a W-4. An independent contractor would be asked to fill out a W-9. And people who aren't self-employed would recognize that form. It's the same kind of form you fill out at a bank for when you open an interest-bearing account. You're verifying your name, social security number, and pertinent information and signing it. If you meet a certain threshold, you will get a 1099, but you could also get one from Venmo. You can get one from Zelle. We'll jump off the subject a little bit, but they're really going to crack down on things like online sports gambling. They're cracking down on ticket selling, if you sell on StubHub. So you could be getting them from various sources. That's not necessarily self-employment income from those other ones, but people who haven't regularly seen 1099s are going to see many more of them, and for different types of activities than they've seen in the past.
So yeah, as you had mentioned a moment ago, we're going to talk about some tax planning tips. Now that we've identified employees versus independent contractors, including those working in the gig economy, having provided those definitions, now we want to maybe get some tax planning tips from you. So the first topic I thought you might share with us a little bit of information about adjusting your W-4 to manage your cash flow. And all of these tips will be for employees, and then we'll talk next about tips for independent contractors.
For an individual who's single, who has one job and not a significant amount of outside earnings like interest, dividends, and whatever, and capital gains and losses, will be fine just filling out the W-4 saying single. I do not like the current W-4. It used to be like a half a page. Now it's like 4 pages. And I will stress that the only thing I fill out, recommend to my clients, their kids, whoever called me, is just fill out that first section. Okay? It's basically, I'm single, I'm married, I'm head of household, and if you want an extra amount taken out, there's a space to say take out an extra $50, $100 per pay, whatever. That's all you fill out. Do not calculate what your kids' credits are worth. It gets, I think you need a PhD to do it, and most clients do it wrong because the more common is you're married. And so this is where it gets a little sticky. So first of all, everyone should understand that prior to 2007, a lot of people got refunds. And those who are old enough to be dated like me could remember, H&R Block got Mary Smith $2,500. And a lot of people shopped refunds, and that was getting the refund was if you get me a bigger refund, I'll use you. It just means you pay too much tax. Okay? It's very, but it's very emotionally drawing for somebody who's not as well informed perhaps about taxes. So basically in 17, in order to boost the economy, whatever other political motives you might have, an executive order was issued where they tightened the tables up. So basically people could go home, say, with $50 more a week, but that means that they would have $2,500 less withheld. So now Mary Smith, who got $2,500, would get zero. Because you had the same income but you didn't have the same withholding. And I think people have gotten used to it, but it really cut into we use our tax refund to pay our real estate tax. We use our tax refund to plan our summer vacation. There was a lot of things that people did with those known refunds as a forced way of savings, right? That's kind of been eliminated.
Mark, another tax planning tip, this has come up in previous episodes, is to max out your retirement accounts. What can you offer on that topic? I
believe wholeheartedly that people should put as much money as they can possibly afford into a retirement plan. The minimum should be the amount that your employer matches. The most common match is either 3% or 5 and they match 4. That's the two most common safe harbors. So if your employer matches 3, you should do at least 3. If your employer matches 4, you should do at least 5, which is how it works. But then in the new tax law that was passed, and it goes into effect next year, is automatic enrollment in 401ks, and there's also an automatic 1% per year increase unless the employee opts out. They used to have to opt in, now they have to opt out. So my advice to people, and we're going to, is a tax savings idea? Yeah, it's great if you have the ability, but at the very least, you should let that 1% go each year.
Yeah, so as looking at this through a human resources lens, there are some employers that do have an opt-out 401k, and so that causes some surprise and shock with employees when they see that payroll deduction and say, I didn't opt into the 401k because the employer didn't share that information. So you always want to know.
Rule going forward is if you're eligible for a retirement plan, you have to automatically be enrolled unless you opt out.
Effective when?
I think it's effective next year. 1/1/26.
That's going to be a big change for a lot of employees.
For a lot of employees. Yeah. But, I think that the reason that they did that, and it underlines a good reason, is because people tend to not think ahead and may say no, or I'll deal with it later. This is sort of forcing you to make your decision. You're making a face. I'm assuming you don't agree with me.
I don't disagree with your logic. I don't think that one should be sort of forced into something. I think that it should be clear that you're opting in or that you have to opt out, and whatever it is, it should be made clear to members of the workforce, and it's not always. That doesn't have anything to do with the current or a previous administration so much with the employer.
I understand that. So the change is, instead of opting in, you have to opt out. Mm-hmm. And I think that in a lot of cases, people maybe aren't sure what the 401k is. We've had things, so maybe letting it go, people who don't know might opt out, not knowing what the risk of opting out is, as opposed to opting in. So I just think that has a little bit of benefit. Mm-hmm. Okay, teach his own. But I mean, it's going to be a new educational requirement for somebody who's in HR.
Mark? Our next question regarding employee tax planning tips is about HSAs. There are HSAs, FSAs, HRAs. So we want to talk about contributing to those types of plans.
Okay, so all three of that you mentioned are pre-tax. And so we certainly want our listeners, and most of these apply to wage earners, to be enrolled in anything that'll save them taxes. So you said HSA, health savings account. A health savings account, you can elect to put away a certain amount of money. Single, married, I think the threshold gets up to around $8,000 for married filing jointly, and over 55, I think it's $8,550. But whatever it is, this is pre-tax money that can be used for qualified medical expenses. It carries over. It can be in sort of an investment account. I recommend this highly to anyone. The determination of whether you're eligible for one is if your employer offers it, but also whether or not the insurance is deemed to be high deductible. An FSA is a flexible spending account. That's what people maybe remember, use it or lose it. So you can defer, I think it's either $2,100 or $3,000, and then use it for qualified expenses. That usually has to be administered by a third party because of HIPAA regulations. And then you had HRA, which is a health reimbursement account, where an employer can have you present a certain amount of qualified bills and reimburse you for that. Again, that had to be administered by a third party. The other thing you didn't mention, cafeteria plans. The most common one in the cafeteria plan is pre-tax health insurance, so you can pay your health insurance if there's an employee component of it. And you also can use it for dependent care coverage. It's called a cafeteria plan because you have a menu of options. There's tuition, reimbursement, there's other things, but the most two common that we probably see is pre-tax premium of your health insurance, that's part of the employee, and dependent care. Yeah. But if you have these expenses, it's much better to do them pre-tax. You probably, even in the lowest tax bracket, will get, say, 15 to 25%.
And I'm a big fan of having a third party administer an HSA, FSA, or an HRA, but specifically the HSA needs to be administered by a custodian. And the HSA is,
one of the most common ones is HSA Bank. There's a bank that's just called HSA Bank. That's one that we use at Zinman and Company. But, I and a lot of other people do too. But there's several financial institutions that have accounts that specifically are for that.
And our last tip here is about itemizing deductions when there would be a benefit. For single, we're at $15,750, and filing jointly $31,500. What insight can you offer there?
So being able to itemize is very difficult in today, at least through this year, because you are capped at $10,000 in taxes. We're going to deal married filing jointly. $10,000 in taxes, your interest on your home, and contributions. It's virtually impossible to get to $30,000. It's a little easier because mortgage rates are up, but it's really tough. Next year, the SALT gets lifted for a couple of years, meaning that SALT is state and local taxes. That $10,000 threshold goes to 40. So it's either the greater of, the lesser of whatever you have, or $40,000. So people may be able to itemize more consistently. I think people who are single are easier to itemize too, because you got $10,000 and then you only need $5,000. So it's a lot easier, but we don't see a lot of people. We see many more people not itemizing since 2017 than do.
Understood.
Especially those who have interest rate mortgages that are a few years old that are very low. Because there's a cap on how much you can deduct in mortgage interest rates too, right? $750,000. So you can only deduct the interest on the first $750,000 of mortgage debt.
So having provided some tax planning tips for employees, now we would like to please segue to tax planning tips for independent contractors, including gig workers. So here you need to keep your business and personal finances separate. We talked about that in previous episodes. It's worth a quick refresher. What can you...
So the mechanism I recommend most is that you should have a separate bank account for your non-wages. Wages are defined as money that has taxes taken out, as opposed to independent contractor, gig, whatever you want to call it, that has no taxes taken out. All that money should go into a separate account. It could certainly be in your name. And then we want you to dedicate a debit card associated or a credit card to only be used with that account, and pay all the direct expenses related to your profession that you're in out of that. So the gig worker, the gas in your car. We could talk, it's a little different with a car, but just think of the tools you use to do your profession, and it would come out directly. And because you don't pay, so we go back to the person who makes $1,000 and has tax taken out versus the person who gets $1,000, no tax taken out. You don't pay tax on the $1,000. You have to account for the $1,000, and you get to pay tax on the $1,000 minus any normal business expenses, which should be less than $1,000. So you're not going to pay, if you make $1,000 a week, you're not going, and you get a 1099 for $52,000, you're not necessarily paying tax on $52,000, you're paying tax on $52,000 minus your legitimate business expenses.
So let's talk about tracking those deductible expenses.
Okay.
All right. 4 different categories we could talk about today? Yeah?
Okay.
All right. Home office expenses.
In my profession, we call them hard costs and soft costs, right? A hard cost is I am a handyman and I have to go buy a shelf for Mrs. Jones. That shelf is a direct cost. The home office is not a direct cost. And the reason it isn't is because of the fact that you get to take the percentage of the home that is exclusively used as a home office. It's usually a bedroom, a second bedroom. So in most of my clients who have legitimate home offices, you're looking at less than 10% of the total square footage of the house. And the formula is business use is the numerator, total square footage of the house, excluding basement, is the denominator, and garages is the denominator. And then you take the relative percentage of all the costs, utilities, water, interest, taxes, maintenance, and that comes off your return. It's a de minimis amount for most people, so we would not count that as a business expense for how we're going to calculate our taxes. We would definitely deduct it on our tax return.
So importantly, though, exclusively and regularly used for business purposes. Correct. Okay.
It could be a second bedroom that mostly has a desk in it that you occasionally might have somebody sleep in, but it can't be your kid's bedroom that you work in at their desk while they're at school. There's a funny line.
How does one audit that?
Well, it's funny line. Anybody saw the first movie, The Accountant? There's a scene there where a farmer and his wife are sitting at the desk, and she's talking about how much money, they're talking about the money back, and he's saying, well, I like to make my jewelry, and she says, well, do you have an office? At the dining table. You mean the workbench? And, she's leading the wife through, all to make it deductible. And that's leading the witness. So, yeah. But
vehicle expenses.
Vehicle expenses, we recommend strongly that you have so the rule about vehicle expenses is that you have to keep a log. A de minimis log, meaning a contemporaneous de minimis log, meaning you have to keep it as you go, which used to be like a notebook in the glove compartment that you filled out dutifully for about 3 days and then forgot about. There are apps now, like there's an app for everything. So one of the ones I recommend, and it's not a commercial, is Mileage IQ, which I think is a Microsoft-based app. It detects your car moving. You can put notes in there where you went. You can swipe left for personal, right for business, and it'll accumulate. It creates. I think I mentioned it in a previous podcast that the average person drives between 120 and 150 trips a month. So going to and from the office would be 2 trips, right? Going to and from the supermarkets, 2 trips. So you can imagine you can go on 10 to 15 trips on a normal day. Some days you don't go at all, but 120, 150 is normal number. So you're looking at 1,800 entries. You hand an IRS agent, or state agent, a spreadsheet with 1,800 transactions that you have dutifully swept left and right and put notes on what vehicle you drove. It's pretty powerful. Mm-hmm. And depending on how we would treat a car would be dependent on whether or not that was how it was used. But basically in 2025, the mileage reimbursement is 70 cents, or you could take actual expense of the car times the business use, which is how many miles I drove for business, 8,000, how many I total, 10,000, 80% of all the expenses are deductible. Mm-hmm. And in some cases, depending on that, if that number's above 50, we would have those costs paid by the business.
Supplies and equipment.
Supplies and equipment. We just talked about the shelf for Mrs. Jones. Yeah. Anything that's direct. Anything that you're. One of the reasons I really like to have this separate account, and we'll get through the whole thing. So one is you need to calculate your taxes. We're getting to taxes eventually here, right? And the second is that you have to make a decision at the time of purchase what you're buying. We have a lot of vendors that are the same, and making that contemporaneous decision to pull out the debit or credit card related to the business, debit, credit card related to personal, determines a lot of value of whether or not you can support that, because you're making a decision. You can go to Staples for your kids' supplies, you can go to Staples for office supplies. Okay. Same kind of thing. Home Depot for a shelf for Mrs. Jones, Home Depot for a shelf for you, right?
What about health insurance premiums?
Well, let's go back to just we'll just finish out the tax part. Yeah. So, interesting thing is then people say, well, we talked about estimated tax payments and how you make them. We want our clients who are self-employed to not have to, whenever they decide to take money, we want that money to stay in the family account. That money should never go the opposite way. And how do we do that? We do it on, the trigger is taking money out of that business account. So if you're going to take money out of that business account, we want you to be able to do two amounts. Let's just I'll make it easy. $500 is what you want. So $500 goes to your account. 40% of that 500, a second one has to go towards taxes or savings account or whatever. So basically we're asking the question that if I made $700, what would my net be? And so that's where we want it to go. And then out of that can come the estimated taxes or whatever. So at the end of the year, whatever's left in your business account or whatever's still in that savings account is what you would use to pay for taxes, not what you took. And it works very well. I've used the same kind of system for 20 years. I've never had anybody come in and have a material amount of money that was in addition to that business account and or the savings account.
Okay. So every time you are withdrawing money, you are withdrawing the amount that you need, and you are taking the 40%, and you are earmarking.
Your need right. It's not 40% of the 500. It's 40% from the bank account. So you need a total of 700. I can use my 1,000, right? So you want it at 700. What's 40% of 700? 280. So it's 980. 280 goes into savings. 700 goes to your account. And I don't want to use the word write check, but people transfer between accounts. It's the same thing nowadays.
Mark, two questions, if we may sidebar.
Yes.
If you are not an employee and you are not a gig worker, but you are the owner of a company with employees, and part of your compensation is provided in the form of an officer distribution, and let's say you get $10,000, and let's say you want to take you receive that money, right? You receive that officer distribution. Let's say some of that you are going to put, let's say, in a checking account for, let's say it's a vacation. Doesn't matter what it's for. Do you recommend that you consider yourself as having $6,000 to spend for that vacation, and you take that other $4,000 and you put it in a different account in preparation for being taxed on those dollars? Or do you recommend something else, or do you recommend using a different percentage? Of course, it will be based upon how much money you're earning.
I think that once you get to a business that has employees, the complications of that are probably beyond what we're speaking about here. Because the question I'm going to ask you is, was that a distribution for taxes? Was that an income distribution? If it's an income distribution, then yeah, I would say you have to probably put away 40% of that for taxes, so $6,000. If it was a tax, it was different kinds of distributions. And again, a lot of how much you have to put away for taxes is going to be based on what happened last year. If you got $10,000 more this year than last year, then you would have had no estimates paid in. And yes, you'd have to put taxes away for that. So yeah.
And everything's coming full circle.
It does come full circle. It gets kind of, my wife complains that we do too many numbers on here and she gets a little lost. And I know that on our YouTube channel, we put up some background numbers and stuff, so edits in there to make it easier for people. So I don't want to get too into the weeds with numbers. But basically, if you are an independent contractor, for the purposes of this episode, we're going to say that you're a sole proprietor, which means that you're either John, you're either just filing a Schedule C or you're an LLC, single member LLC. For the purposes of this one, it starts to get really confusing if you start adding in employees, distributions from third parties, whatever. It gets the tax planning becomes a little bit, yeah. I know that I give this talk that we're doing right now to a real estate school every like three or four times a year. I have a friend that owns a real estate school, and so that's a typical independent contractor. So I give them the same kind of like, treat your business as money, put it away, and I watch their eyes roll back in their heads of like explaining that, let alone getting into it. So, yeah.
My second sidebar question that I want to ask you has to do with managing your money so that when you need to file your taxes, you are prepared to do so, and that you will have more of an administrative burden doing so as an independent contractor than if you are a traditional employee for another company.
Absolutely.
Okay. So there is a school of thought that if you manage your finances in such a way that you get back a large refund, that's fun because you can use that. I'll again use the same example as for a family vacation. With it being 2025, again, there is a greater opportunity than there was 20 years ago for identity theft. So if you are receiving a tax refund, there's a little bit more potential exposure there. So my understanding is that it might make sense for someone to have to pay taxes every year a small amount, because if you're getting back a large refund, you've basically given the government, the state or local government, an interest-free loan. So this is less risky, and also you're not loaning money to somebody without getting interest. What is your right, wrong, what is your opinion, what is your recommendation on that topic?
It's a great topic because, I prepare a lot of tax returns for clients, and when they get a refund, I'm great, and when they owe money, I suck. It doesn't make a difference, the reason. So money is very emotional, which is why we mentioned having that separate account and a formula for putting away money, because we don't want you to count it as your money until it's your money. So we want that money to either still be sitting in that business account or be in a savings account for taxes, because once you take it, then you feel like you lost something. So, and it's also risk reward. Years ago when it was $2,500, yes, I wasn't getting my 5% on my $2,500 for the amount of days, but it's cost benefit. Is it from a financial literacy point of view? Owing nothing or owing a small amount and not getting a refund is the way to go. But from the fact that people tend to feel better about getting a refund, it needs to be managed. You should be doing tax planning. There is software out there even for individuals where you can dump in your numbers. We talked about W-2 employees. Once you have more than one of you, meaning you're married, it gets more complicated because unless you're going to fill out those graduate level document W-4, it doesn't really know what your spouse is being met. And quite often when we have two wage earners who earn anywhere near the same amount of money, we tend to have a tax problem. Why? Because if somebody earned $180,000 and somebody earned $20,000, no tax problem, because the employer is going to take out the tax on the $180,000 and the $20,000. But two people earning $100,000, it's the same $200,000, but your employer for the husband only knows about the $100,000 they made. Employer for the wife only knows about the $100,000 they made. Put it together. Somebody made the first $100,000. Somebody made the second $100,000. There was only one $32,000 standard deduction. Meanwhile, it's factored into both, so it starts to get more complicated. And we do find a lot of people who owe money, but that's a reason why you need to have maybe a tax professional to do the work. Not that and it could be an enrolled agent, which is somebody who's authorized to practice in front of the IRS, who's passed a test, a CPA, a tax attorney. It could be any one of those type people, but you need somebody to be a professional, because I think that understanding your taxes is more important than owing it. It's not whether you owe or don't know, it's whether you understand why. And quite often I can easily say to you, Monica, if you're following the safe harbor and everything else, and you owe taxes on April, that means you had a better year because your taxes were based upon what you made last year and you made more money this year, so you owe money. You're getting a refund. It means that you overpaid because you had a worse year. It's the same reason why we talk to our business clients, and somehow they tend to manage their business on how much money is in their bank account. But there's two times that you have a lot of money in your bank, right? You're making a lot of money, or your sales have really fallen off and you're liquidating. You're liquidating your receivables, you paid your payables. So you can have a lot of money and you're doing badly. So how do you know? Well, you need to have the kinds of records and mechanisms to be able to trigger to know what's going on, which is for that self-employed / gig worker can be this really simplistic system of just having a separate. You don't need to go out and spend a lot of money on QuickBooks or Sage or something. Just a nice keeping a bank account and being able to have all those transactions in one place so you can put it together on a spreadsheet is all you need to do.
And do you want to talk a little bit about, just so individuals, if they're not aware, about self-employed retirement plans?
Yeah, so basically, the self-employed retirement plans mimic those that are offered by an employer. There's a single member 401k. So that if it's just you and your spouse who are working there, or your children, then you can have a solo 401k, which has the same exact rules of deferral. You have a SEP IRA or a simple IRA, which is the same as can be offered by an employer. They very much mimic each other now. The other thing to note that if you are putting in a retirement plan, there is credits available for this year and for next year for any administrative costs that are associated with either putting it in and or administering it going forward. For the most part, for those solo people, there isn't. The only time you really start getting into administrative costs is a 401k when you have multiple employees. And the other thing that one other thing we didn't talk about, expense software.
So that would be our last point before we just kind of talk about, very quickly wrap it in a nice box with a pretty bow when we talk about someone who maybe is an employee and also has a side hustle, right? But before we get to that, our last bullet point is, when is it appropriate to invest in expense tracking software, and when would you consider that to be unnecessary?
Well, it's unnecessary for most sole proprietors, meaning a single person who is a gig worker or whatever, because in essence, you're only buying for yourself. You should know what you're buying. You should be documenting what you're buying. However, if you're that same person and you have to, your contract is cost plus material, cost plus, and you have to document that, then maybe you want some kind of expense software to be able to assign it to a job. There's simple ones out there. QuickBooks has them. Look around. There's a million different ones out there now. The most common is if you use a credit card or a debit card, it will remind you you need a copy of the receipt, or you need to note it for some kind of a text on your phone. That's the most common. And there are several types of software out there that do that. We tend, for our clients, to try and cater to what they're looking for. The problem is, I can even talk to myself. We have 25 employees here at Zinman, and a lot of them use credit cards for different things for clients. It's chasing down stuff. What was this for? When it wasn't me, is hard. So we've had a couple different systems, and now we use Ramp here. I'm not trying to do commercial for anybody. There's Ramp, there's Divvy, which is part of Bill.com. There's Expensify. There's a million of them out there. But I would only use expense software if you can't keep track of what you bought, which means it's not just you buying it, or you have to document it for some third party like your customer.
So I'll say, you hit me about 2 weeks ago with, this is your new credit card and this is the new software we're going to use, and I love it. I will get a message asking me a couple questions. I type it in, bing, bam, boom, done, as opposed to the process that we were following prior to that, which was not as efficient. So huge fan of that change that you made within our organization.
Right. And a lot of these things, you can spin up virtual cards. You can I could spin up a virtual card now. What's a virtual card? A virtual card is the account number without having the actual credit card.
And also the limited purpose cards.
That could be a limited purpose card. It also could be obviously for online purchases, you don't need a physical card, so you could spin one up. You can spin one. Employers can spin one up based on the vendor, a certain amount of money over a certain period of time. There's a million rules that you can put into effect to limit your exposure or risk of an employee misusing it. But mostly, we're not doing it for the fact that employees are misusing it. We're doing it for the fact that I don't know what the heck you bought because I didn't buy it. I see you bought something, and I'm sure it's legitimate, but what was it?
Yeah, absolutely.
If I hit, spend on Amazon, I know I bought, pads or a paper for the office, or I went to the supermarket and bought coffee and cream.
Right.
But if an employee does it, I don't know what it is, so I have to ask, and that asking is time consuming.
Exactly. It's much more efficient.
Correct.
Okay. All right. So if you have a primary W-2 job, we'll call it, and then you also have a side hustle, let's talk about, just as we conclude today's episode, two pieces of advice that you could offer to such employees. So one is to adjust your W-4 withholding to account for your taxes for your side hustle. So adjust your W-2 withholding with your employer to account for the additional income that you will earn from your side hustle. Yes or no?
Yes, if you had to make, yes. So your choice is either to increase your withholdings at the employer or do estimates. It is the same with W-2 earners when we just talked about that see people making $100,000. You're either going to have to go to your employer and increase your withholding because it's taking too little out because it doesn't know about the other job, or you're going to have to start making estimates.
Yeah.
And it depends on that decision about making it is how easy it is. We live in Pennsylvania, which is a flat tax state, so if you're going to have to make estimates of Pennsylvania, you might as well do estimates of the Fed too. But if you live in a state that maybe it uses adjusted gross income and therefore it allows for the same deductions for federal, then maybe you go to your employer and have them, again, I don't want you filling out that whole 4-page thing. I want you to do a fixed amount per.
When did that has that been how many years now? Is 6 how many? It causes a lot of problems.
It was changed around 10 years ago.
Was it 10 years? Okay.
They were trying to give people more choices to be able to control the refund, and unfortunately it just made it so damn complicated. Because you were getting a $2,000 child tax credit. You got a $30,000 deduction, but there's only one. There's only you and your wife or you and your spouse share the same child, so there's only one $2,000. It's only one standard deduction. It got very confusing, and so we just tell people, let's just avoid that.
And then another piece of advice that you might offer is just be aware that if you are an employee and you also have a side hustle, you're going to have a couple different tax forms that you might not be used to getting.
Yeah, I mean, you get a W-2 for being an employee, you get a 1099 from it's called a 1099 NEC for a self-employed person, or you could get a 1099K from Venmo or Zelle or PayPal or something like that. So you're going to get different forms, and you just need to, listen, the forms document what you got. It's not how you file your taxes, right? If you're depositing the money in a separate checking account and you're filing what we just talked about, it doesn't make a difference. Those forms, unless they're incorrect, are just documenting what you already got.
But you want to make sure that your tax professional is aware. So if you're using a tax professional to prepare your taxes and they're looking at last year's returns and you didn't have a side hustle, then they're not going to know to ask you for it. So you have to provide full disclosure to your tax professional when you get these additional.
For example, I have a client, we just onboarded a new client in June, and she reached out to me today because her husband has a W-2 employee and she is a consultant. And so and last year she was still in school. So she now knows that we're going to have this W-2, and what do I do do I have to make an estimate? And the question is going to end up being, back to that safe harbor, do you want to pay your taxes now or you want to pay them as late possible? We want you to pay them as late as possible, but we don't like surprises. So if you're going to owe $5,000, if you're going to owe $10,000, do you have to pay them now? Yes, if you didn't meet the safe harbor from last year. No, if you did, but you're still going to owe that. It's the same money as when you owe it. And to your best practice, we want to pay the government as late as humanly possible. Okay, so yeah, I'd rather owe in April, but if you don't know what you're going to owe, it's going to feel like it's an expense. So taxes are very emotional. And so, that H&R Block commercial where they got Mary Smith $2,500 just sounded great to the average person because, wow, can I get $2,500? But the question is, did you overpay $2,500? There's many less deductions available to wage earning people than it was before. Many more people are doing a standard deduction. Many more people are not able to itemize. Many more people, there's no employee business expenses. There hasn't been that since 2017, and it continues with the new tax law that was passed that there is no employee business expenses. So it's basically reporting your income, and we talk about estimated tax. Another place where people pay estimated taxes, if you have outside, is we talked outside income. Yeah, we talked outside income on a gig or on a contractor, but earnings from stocks, bonds, capital gains could also yield you to have to do estimated taxes too, because it's another source of income, and those sources of income have no taxes taken out either. They may not be subject necessarily to Social Security taxes, but it certainly be subject to federal and state taxes on that income. And I had a client call me last week, and they were like, I want somebody who's going to be proactive and help me manage. I don't want to pay any taxes. And so he sends me his return from last year, and he had $200,000 of income from day trading. Well, that's ordinary income, and we call it marginal income, meaning so when we talk about income, and we talked about in another episode, you stack your income, right? Well, what comes first and what comes last? So, you just pick one person, they get the first 100,000, then the other person gets the second 100,000. You already are working and you had the 200,000, and now you have a day trading at home and you make $200,000 like this gentleman did. Well, that's the last income. And we live in a situation where we have a graduated income tax where it starts 10, 12, 23, 24, 30, 31 and up, and 35 is the maximum. Whatever the last dollar you earned is at that marginal. So when somebody says, what's my effective tax rate? Effective tax rate is taking the total tax that you owe as a numerator, and the denominator being your income. So, okay, my total tax was $10,000, an example. My total income was $100,000, so I'm at a 10% effective tax rate. But that $100,000 may be in the 24% tax bracket, right? Because the first part was 0, the next part was 10, the next part was 12. And we do a lot of tax planning around those marginal income tax to fill them up. It's not bad to pay taxes. It's bad to pay more tax than you need to. But you shouldn't want to pay no taxes. You want to be able, so we're talking to people that are retiring now, right? They put away their 401k, they put away their money in pre-tax at a higher rate to get that deduction, maybe at 35 or 24 or 31 or something higher, right? Well, we don't want to lose that 22% bracket. We may want to backfill. We quite often have people take distributions when they don't have to, just to make sure that we're managing the taxes. So taxes aren't bad. They're a consequence of an economic decision, not the reason to do it or not. I've said that one before.
I've heard that somewhere before.
It's just, it makes it sound less emotional, right? I get people to say like, well, how much am I going to owe if I sell my house? Well, did you want to sell your house? You want to owe as much as humanly possible, because it means you sold the house for the highest value, right? It's just the consequence of doing that. It's not whether or not you should sell your house. The timing of when you're going to sell a stock, the timing of when you bill a customer, and that may get paid in January instead of December. Those are all tax planning techniques, but not tax avoidance techniques, right? You're just planning. So what they say is death and taxes are the two inevitable, so you're going to pay taxes. So it does drive me as a professional a little nuts when people want to avoid taxes. You can't avoid them, you just have to manage them. It's just part of that management. Best advice I can give, and it's the same for whether you're a W-2 earner or you have more responsibilities if you're a gig worker or an independent contractor, because nobody's withholding for you, but you still end up with the same amount. If you earned $50,000 as a W-2 employee or $50,000 as an independent contractor, you pretty much have the same taxes. It's just how it got paid in, and who had to pay it in, and when you had to pay it in. And withholding is statutorily considered to be paid pro rata throughout the year, whereas if you don't make your estimated tax payment, they know you didn't pay it April 15th, you paid it late or didn't pay it at all. And so there's a trail. So we sometimes do use extra withholdings from the W-2 person to offset the estimated tax, because maybe we don't know exactly how much. It gives you a reason to pay tax later. You can make a big estimate, you can make a big tax payment by having most of your payroll go towards a withholding on December 31st, and the IRS doesn't know you paid on December 31st because withholding is considered to be evenly throughout the year. They don't know when you paid it. They just know you have that number on your W-2. But they know that you made your estimated payment on December 31st.
So maybe, in a future episode, we might talk especially for small business owners who may be listeners or watchers of this podcast on, let's say, YouTube. We might want to have an episode about what expenses you want to pay at the end of the year.
Yeah, so it'll be coming up because as a practicing CPA, that's going to be a topic that we're going to talk with our own clients, and we're going to talk to them mostly in December. Yeah. And why? Because unless you really know that you're, like, I have a real estate agent client who was moaning like 6 weeks ago how bad a year it was, and then said to me, I think I'm going to have the best year ever because like people woke up and decided to sell their house. So, she ended up with a lot of listings that are all getting like mushed together. So instead of selling houses in June, July, and August, she's selling them all in September, right? But she's still going to sell the same number of houses. So sometimes you don't know till we get towards the end of the year. So you can't tax plan on a number you don't know.
All right. Well, lots of great advice and insight that you shared on today's episode, Mark. Thank you so much.
You're welcome. Thank you.
We want to thank everyone for tuning into today's episode. Let us know your thoughts below, and don't forget to like the video and subscribe to the channel. We hope everybody has a good rest of the day, and we look forward to seeing you next Wednesday. Please continue listening for bonus content. Mark, I understand you're going to share some information about the deductibility of automobile interest.
Yeah, so after we filmed our last podcast, I was in bed and I went, oh, Jiminy Crickers. So we had mentioned about the deductibility of car interest, which has always been deductible for businesses, but not for individuals, at least. But the Big Beautiful Bill, or it was the Big Beautiful Bill, whatever they're calling it now, had a deductibility in it. But it's fairly ridiculous. But I would be remiss if I didn't mention it. So what is deductible? Automobiles that are assembled in the United States are entitled to have up to a $10,000 per year interest deduction that starts to phase out once you make more than $100,000. So let's count on some fingers what that means, okay? First of all, if you had $10,000 of interest and only made $100,000, 10% of your gross income would be going to a car, which is a huge amount of money. And even if you bought a $100,000 car at 8%, you're still only paying $8,000 in interest. So the 10 doesn't really mean anything. I would certainly not recommend to my audience to buy a car based on the deductibility of interest, or just the same way we talked about maybe a deductibility of an interest rate on like a teaser interest rate on a car, or a lease rate might make somebody do it. This is just one of those things to add on. But I just want to make sure I was clear that there is some deductibility interest, and it wasn't really a big topic, even though we mentioned it, because the amount of how much is going to benefit any person is going to be limited, but it's still available.
Thank you for that clarification. All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the Mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.